What is the PE ratio and how does it lose investors money? Why is the most popular measure in stock investing almost completely useless? In this video, I'll show you why the PE ratio is a sewer of information, how company management tricks you into this. I'll also reveal 3 alternatives you can use to find the real value for stocks. We're talking price to earnings ratio today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Investing is an entertainment industry. Those of you in the nation have heard me say that before, and today we're going to talk about the sitcom of the investing world, the slapstick comedy of stocks, the PE ratio. Now I know you're thinking, but everybody uses the PE ratio when they're talking about stocks. From billion-dollar hedge fund managers and analysts on TV, even here on Let's Talk Money, we've used the PE ratio before. So how is it then that this is the worst thing to happen to investors since Bernie Madoff told you to invest in Enron? Because the PE ratio is so phony that it's almost completely worthless. It's an overly simplistic number that fools investors into thinking that they know what a stock is worth. It's an easy soundbite for analysts to entertain you, keep you trading, and keep you losing money. Now in this video, I'm going to show you what the PE ratio really means, why you should never trust it alone. Then I'm going to reveal 3 alternative ways to find a stock's value that is going to help you make better investments. So let's get right into it with the price to earnings ratio. The appeal of this little investing gremlin is that it's so easy. It's just the price divided by a company's earnings or its profits, usually counted over the last year. Now, every company with shares traded releases an earnings report every 3 months to release their finances and performance over the quarter. Since stocks are an ownership stake in the company's profits, that earnings number is what everybody fixates on and what gets the most attention in the markets. So if we look at shares of Apple here on Yahoo Finance, and you can get these earnings numbers from any investing platform or straight from the company's financial statements. But if we scroll down to see Apple's total earnings per share of the stock here we see that Apple reported $2.18 in profits for each share of stock last quarter. It was $2.46 a share in the previous, $4.18 in the quarter before that, and then $2.91 before that, for a total of $11.73 made by the company over the last year. Now scrolling back up, we see that shares are trading for $242.46 as I'm recording this, and if we take that price divided by the earnings, we get a PE ratio of 20.6 times. Now what this says is that investors are right now willing to pay 20 times Apple's annual profits for a share of stock, an ownership share in future profits. Now the media loves to talk PE ratios because it's easy and investors just eat it up. It's easy to calculate, easy to understand, and gives you a comparison of value. For example, if Apple trades at a PE of 20 times earnings, and we see here that Microsoft trades for 27 times, we can say that shares of Apple are relatively less expensive than Microsoft. Now that little tiny innocent word relatively is going to be an important one, and we'll get to that. But first, there's actually 2 types of PE ratios, and understanding the difference is hugely important. The one you see most often is called the trailing price to earnings. Now this is the most common and just the price divided by the last year's earnings. Sometimes though, you're going to hear an analyst talk about the forward PE. This is the price divided by the profits analysts think the company is going to make over the coming year, over those next 4 quarters. So obviously that is a big difference. One is the price against actual earnings. The other is a price against an estimate, and sometimes maybe not so great an estimate of what profits are going to be in the future. The problem here is that Wall Street expectations for a company's earnings are almost always higher versus the company's past performance. Even when some decrease is expected, it's rarely more than 1% or 2%. What this means is that forward price to earnings ratio, that current price divided by the expected earnings, it's almost always going to be lower than the trailing PE. Now this makes a stock look cheaper because even if shares are trading for that 20 times last year's earnings, an analyst can point to higher hopes for the next year and say that the price is only like 15 times those expected earnings. Now that's going to be warning number 1 for the PE ratio. Always be careful when analysts start talking about the forward price to earnings ratio. A lot of times it's because shares are ridiculously expensive when looking at that trailing PE, but look much more reasonable when you assume a year of higher profits. That forward price to earnings is like a 12-year-old. The world is full of rainbows and unicorns, and stocks will always look better. Now I want to talk about that word relative and why it's so important before we look at what's wrong with the PE ratio and those 3 alternatives. And even though I hate the price to earnings ratio, I want to spend some time talking about it here because I know that so many investors are still going to be using it. even with some of these alternatives that we'll look at later in the video. So when you start looking at a PE ratio of a stock, the first thing you're going to wonder is, well, is this 20 times earnings for shares of Apple? Is that good or bad? Is it cheap or expensive? And this is where that seemingly insignificant word relative becomes so very important. Now, a PE ratio for a stock is only good or bad, cheap or expensive, when you compare it against another ratio. Knowing that shares of Apple trade for 20 times earnings only means something if you know that the shares have traded as low as 12 times earnings over the past 4 years, or that 20 times is about the highest it's been over that period. So here we can only say that Apple shares trading at 20 times earnings are expensive compared to their value over that last 4 years. Another way of looking at the PE ratio of a stock is comparing different companies like we did with Apple and Microsoft earlier. But there are two things you really need to know here when you're comparing these PE ratios of two stocks. First is that you absolutely must compare PE ratios of similar companies in the same sector. Now, comparing the price to earnings value of a fast-growing tech stock like Apple against something in the financials like Bank of America just isn't going to tell you anything about either stock. Earnings for tech stocks like Apple just grow so much faster that investors are willing to pay more for those earnings, a higher price to earnings multiple. Even though it might be more expensive on that PE basis, shares of Apple might in fact be the better investment if those faster earnings growth can keep up with the shares. In fact, here we see the current average PE ratio for the 11 stock sectors and the S&P 500, and you can see how much this variation here with energy stocks trading for a low of 17 times earnings and tech stocks trading for an average of almost 22 times earnings. Instead, always remember when you're comparing the PE ratio of two stocks or using any of the alternative multiples that we're going to talk about later, make sure you're comparing stocks within that same sector or even the same industry. Second here is that even comparing the price to earnings against two stocks in the same industry, it might not tell you which is a good investment. So let's go back to that comparison that we made earlier, the shares of Apple versus Microsoft. If Apple is trading at 20 times earnings and Microsoft is at 27 times, does that mean Apple is a better or a good investment at this point? Does it mean you should avoid shares of Microsoft as just too expensive? But what if shares of both companies are just too expensive? Now, we've already seen that Apple is traded as low as 12 times earnings just in the last 4 years. Now, that's 40% less than where the stock is right now. So always remember that the PE ratio is a relative measure. It's only going to tell you if a stock is more or less expensive relative or compared to another stock or that company's own PE history. To understand if a stock is really a good investment or not, you have to take that lower PE ratio and combine it with other analysis to understand why behind the price and where it could be in the future. That's really the second warning here about the PE ratios, that you need to watch out when comparing them and always compare the PE ratio of a stock against its own historical average and then only against the price to earnings of other companies in the same industry. Now, why is the PE ratio so bad? Why is something so simple and easy to use one of the worst ways to look at a stock? So think of a company's income statement. That's where it reports those sales and expenses and profits each quarter. Think of it as a long trip down the sewer. You jump in ankle deep where the company is reporting sales it made over the last 3 months. Now there's ways to fudge these sales numbers, but it's still pretty clean. But then you start sludging along down the income statement. The company reports the cost of its marketing and general expenses, each with more ways to make the company look better. The sewage gets a little higher, but you keep walking. For example, remember when AOL shipped out all those annoying startup disks in the 90s? Okay, you know I'm old here, but when it did this, instead of saying that the costs here were a marketing expense, which would have decreased profits, the company counted these as long-term investments that it could write off over years. It made earnings look way higher than they would have been otherwise. Now, other accounting shenanigans include a company extending more credit to buyers so it books those sales even though the contracts may never be paid, or just in the way that it accounts for inventory it's holding. With each expense the company reports, management has the opportunity to use a few more accounting tricks to make expenses look lower and ultimately make those earnings look higher. Pretty soon, you're waist deep in a shitty income statement and looking at earnings numbers that have more fiction than a smut novel. And why does Wall Street love the PE ratio even though everyone knows it's bullshit? Because when investors hear that shares of Apple are less expensive than Microsoft, what do? They rush out to sell Microsoft and buy Apple. When the next day they hear shares of Cisco are cheaper than Apple, they rush out to sell Apple and buy Microsoft. It's all an easy, entertaining way to get you to trade more. And if you think trading commissions were the only way that brokers were making money, think again. Not only is investing an entertainment industry, it's also a casino, and the longer that Wall Street can keep you trading, the more money Wall Street makes. So now let's look at those 3 alternatives to the PE ratio. 3 ways of finding a stock's value that are just as easy, but are gonna help you avoid some of those shenanigans that go into earnings. First though, I wanna invite you to a free webinar I'm giving on a unique goals-based investing strategy I created with private wealth clients. In this webinar, I'm going to show you how to personalize your investments to fit your own goals to make sure that you're making the right investing decisions based on your needs. Now, I'll put a link to that webinar below in the video description. It's completely free, but the platform restricts how many people can attend, so make sure you reserve your spot. Now, our first PE alternative is going to be the price to sales ratio, which is probably the second most used multiple. Now, the price to sales is simply the current share price divided by the sales per share reported over the last year. Now, the difference between using sales and earnings to find a stock's value might seem kind of insignificant, but just think back to our sewer example. That top line of the income statement, the reported sales number, is relatively clean. As you walk down the statement through the expenses and the taxes and the interest and debt, the accounting shenanigans just piling up and the numbers get less believable. So it just makes sense to use a number you know is cleaner. Now, the sales of the revenue number isn't reported on a per share basis as frequently as earnings, so there are 2 ways you can find this. First is you can take the market cap of the company, that's the price times all the shares issued, and divide that by the company's revenue. For example, we see that Apple has a market cap of $1.096 trillion and a revenue of over the last year of just over $259 billion. That equals a price of 4.2 times its sales. Now, you'll also find the price to sales ratio calculated for you on a lot of sites, but it's really easy to do the math yourself, and I like to double check these numbers. So the other way to find the price to sales ratio is to divide total revenue by the number of shares issued to get that per share number. So taking that $259 billion in Apple revenue divided by about 4.5 billion shares gives us a $57.30 per share revenue basis. Then we take that price per share of $242, divide by the revenue for that same price to sales number. Besides that price to sales ratio, another alternative here is to use the price to book ratio. Now, the price to book ratio is just the share price divided by the value of the assets a company owns minus the debt it owes. You'll find those assets and debts of the company on the balance sheet, so it's a totally different financial statement apart from the income statement that shows those earnings. To find the price to book, you look at the balance sheet and you can take the total assets minus the total liabilities, or just look for this line called total stockholders' equity. This is the investor ownership after debts are removed from a company's assets. Now again, that's a whole company number, not the per share basis that we need, so we need to do the same thing that we did with revenue. We can either take that market cap of the company divided by the whole stockholders' equity, or we can divide the stockholders' equity by the number of shares and use that share price. Here we find that Apple has shareholders' equity or book value of $107 billion. So if we take that market cap of $1.096 trillion divided by $107 billion, we get a price to book value of 10.2 times. And there are a few pros and cons of using the price to book value instead of that PE ratio. First is that the price to book ratio can be a better measure of companies with lots of depreciation or other financial assets. These can throw off the income statement, so you want to use that price to book instead of the PE ratio for financial companies like banks or real estate companies. Now, I like the price to book also because it gives you a valuation based on assets and what investors actually own in the company, that stockholders' equity. The downside to this is that book value can also be manipulated by management, so this isn't necessarily a sparkling clean number either. The company's assets include estimates for values of acquisitions that can be wildly off from reality, and liabilities might be skewed by interest rate assumptions. Now, our third alternative to the PE ratio is the price to cash flows, and this is probably the cleanest of the 3. Now, the price to cash flows ratio is the stock price divided by the cash flow from operations reported on that cash flow statement. So here we're using the third financial statement put out by a company each quarter, the statement of cash flows. This is where the company reports actual cash coming in and going out through operations, investments, and financing. Now, the major benefit here is that it's much more difficult for management to fudge those numbers on the cash flow statement compared to the income statement or even the balance sheet. This is actual cash flow coming in and out of the company, so the accounting tricks available are harder to come by. Now, let's say if the income statement is a sewer, that cash flow statement is more like a mud run. Still a little dirty, but you won't need a tetanus shot after reading it. And this is going to work like those other 2, the price to sales and the price to book ratios. You get that operating cash flows for the last 4 quarters from the cash flow statement. You can either divide that market cap number against this or get the per share cash flow number by dividing it by shares issued. Now, besides being a little more reliable, that price to cash flow ratio is also helpful when a company is reporting positive cash flows but negative earnings, which is going to make that price to earnings ratio even more useless. Now remember, with all these price multiples, these are all relative valuation measures. That same rule applies here for comparing the price to book, the price to sales, and even the price to cash flows against its own history or against similar companies in the sector or the industry. Click on the video to the right for the 10-step process I use to pick stocks. This is a complete guide on finding the best stocks, the same process I used for venture capital and private wealth managers. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.